Alright guys, welcome to yet another video by me. Today's topic will talk about the best time to DCA dollar cost average for the S&P 500. In general, I'm just taking in S&P 500 because that's where the dollar cost averaging approach is used. I mean, dollar cost averaging can also be used for any other stocks method as well. And it begets the questions, can you really time the market? First off, the disclaimer here. As we can read, this is not an investment advice, of course, and it's just an inquisitive poke at questioning the convention of it's impossible to time the market, because this is a very popular saying, right? Time in the market is better than timing the market, right? So that's how everybody takes the DCA approach generally. I like to say that the suggestions in these presentations are developed purely based on the theories that we discuss. And of course, if you would like to apply these theories, you should do your own due diligence before you apply them. Right. So as I mentioned, the Paul's popular saying, the time in the market beats timing the market. Is it true? Can be at face value. And statistically, I believe everyone has done the homework. But here is a more educational approach that I would like to take is that do we question it? I mean, we hear it. So do we accept that as truth, or do we develop a conviction here based on our study of this question, and then develop that confidence to say, yep, I have done the background and research, and I have noted that this is true. Because the feeling of buyer remorse is real, right? Whenever you bought a stock and then it goes down, like why did it go down? It doesn't feel good to see it go down. And is it true that the big boys here are out to take the money from the uninformed? See, do they, give the saying of time in the market beats time in the market, so to encourage participation from you so that your money goes into the market? Is that what they want? So this very beautiful. I just want to take a light-hearted approach here and examine these questions. So I'll like to quote Albert Einstein here, saying play is the highest form of research. So here we're gonna adopt a playful approach on how we can examine the questions. Okay. Next, we have a first principles approach, right? So we all know that buying low and selling high is the most profitable method. But the question here is, how do we buy at the lows? Right? What is the low? Okay. And here I'm talking about the candlesticks you see in the graphs, the charts of the price of whatever stock or securities that you are looking at. Okay. If you're expecting a green candle, right, the low will always be below the opening price of the candle, right? I mean, this is very dead obvious. But do you apply that knowledge to say, if it's a green candle, I will buy below the opening price, and so I get a better discount of this when I enter, right? And then the next question is, okay, so if I like to buy the low, how do I know this is the low, worst low, right? So I here like to introduce a concept that there will be a price signature accompanying a low. Okay, that's a reversal. What happens during a reversal? We'll examine the charts later. Okay, so here we also don't try to be perfect to call the lows, but at least from a DCA perspective, we would like to aim to buy near the lows. Okay, so we want to buy low to sell high. I'd like to introduce this person called the Inner Circle Trader. So from here, this is a screenshot of his YouTube web page, right? He has 1.19 million subscribers currently. As of this date, he once sold courses about price action and the theories that he have behind it. But he has stopped doing so, and all the videos he has loaded in his channel are absolutely free, and they are from his paid courses. All right. So as it's all free, you can just take the time and effort to go and start off with these videos and learn from him. So his expertise is intraday trading, and he treats price action like technical science. That why price should move the way it moves. That's his approach. So I personally have applied and learned his concepts how I interpret the markets, right? So all credits will go to him because of his concept of power of three, right? Which I'll short form it here as PO3. I'd like to first give a brief illustration of for those who don't know. This will help to further develop our discussion later. All right. So this is a candle, and it has four main data points. It's open, it's low, it's high, and it's close. So from this picture here, you can see for a green candle, the opening price is the bodies of the candle, the horizontal bar over here. Okay, that's the opening price. The low is this wick here. It shows the lowest price this candle has reached in this given time point, right? And the high is the highest point the candle has reached and its highest point. And then the close is the body, the highest part of the candle's body, horizontal line here. All right. So with that, have a very mental picture captured of this image, and we will use this to expound our theories. So power of three is about three phases of price delivery and how it blends with the four data points in the previous slide. All right. So there are three phases are accumulation, manipulation, and distribution. So if a candle is bullish, we will assume that it will accumulate orders near its opening price and then descends to its low. And this descending leg is called the manipulation leg. It lures people thinking that, oh, prices are going low now, and people will start shorting it. All right, but then it reverses and expands upwards. So this ascension is called distribution. So what is actually happening here is that the orders bought during the manipulation leg or the phase are sold at the distribution phase, distributed to the higher prices. So it's literally you buy low and you sell high, right? And then price ends off the day by signifying the close. So there's nothing much about the close that I really want to talk about here, but basically it's accumulation, manipulation, and distribution. All right. So let's look at the candle again. It opens at the near the open and accumulates order all the way to the low in order to distribute the orders bought here in discount to any point here up to the high, and then it consolidates again and close. Yep, that's what power of three is. Then the next thing I'd like to talk about here is one of the price signature of a reversal. So I'd like to introduce this term by ICT. It's called the change in state of delivery, right? So we're going to only talk about from a bearish to bullish reversal aspect, because we're talking about DCA here. We're only buying. There's nobody selling here. Okay, so change in state of delivery or price. So from what I explained just now, the orders that were distributed from the highs and to the low, and now there's going to be a change in the state of delivery, so that the orders that are being sold will now be buying orders at the low and now going back up to for higher prices. All right. So during a reversal, I like to introduce this new term called the order block. Okay, the order block looks something like this. It's a very gross depiction of it. It's generally having a shorter red candles beside a taller green candles with its closing price exceeding the opening price of the red candle. Okay, so if you see a candle formation like this, can be as many as 3 candles before the green candle, and there can be some candles in between these 2 candles. But what's more important is note that candle, the green candle that exceeds the price of the red candle. Okay. So when it forms, we would like to observe the second candle. Okay. So the candle here is black because it can be either red or green, right? We want to see the reaction of price at this point, the opening price of the red candle. If there is a rejection away or the price moving strongly away, we can see a formation like this with a very long bottom wick. First price came down and is being pushed back up again, meaning to say that it does not want to stay here, but it wants to go higher. So this kind of confirm the signature of an order block, and that's what we want to see. And we do not want to see the next candle closing beyond this 50% of the red candle. If it close below, we could show that it is probably going lower already, right? So with that, we observe the next candle after this black candle and buy at that, because we are buying near the bottom already, because it's predisposed to be going up based on this signature, right? So there are better entry techniques, but there are levels to this. So this is just what I feel from a simple point of view, how we can approach what I'm going to say. Okay. All right. So this is TradingView, and I'm on the ticker SPY, which is the commonly bought US indices for dollar cost averaging method, right? I mean, I'm not going to argue whether it's SPY or not, but I just want to really explain the concept of the order block here. Okay, we have the year 2023 here marked by these two vertical points, and these are on a weekly time frame. So all these candles are a weekly candles, so there should be about 52 candles in this uh, view. So where we start off here is that a little bit of carryover context from last year, right? So the order block form is kind of about three red candles that the green candle exceeds it. So this horizontal line here, as you can see, is the order blocks opening price, and you can see price kind of quite well supported by it, right? You can see here it stops right around here and it moves away. So our criteria here is we need a green candle that exceeds the red candle, okay? And the next, we observe its next candle after the green candle. We want to see price moving away from the red candle's opening price as much as possible. And should not close below 50% of the red candle here. So this is quite a good example over here. You want to see a long bottom wick here, and then we purchase on the next candle. All right. So we made our first purchase in 2023 over here in this candle, and following which the next purchase was in February, where this candle touches the order block again and moves away, and we purchase here. Unfortunately, price declines, so it doesn't matter. We're just following the rules here, okay? And there's a little bit degree of discretion allowed as all imperfect humans execute, right? You Okay, so the next instance is that this order block was created and this green candle exits it. We want to see price touching it again and leaves, and then we purchase at the next one. So two more shares purchased here in the month of May. And here is another order block again with a green candle exceeding these two red candles. And we can see here price touches it and leaves, and I purchase it at the next candle. Oh, here, so in the month of May, was very close to June, so I just take it as we purchased for the month of June. There was no further entries here because there was no low per se. Okay, the next low that we find here is the order block over here. So we have green candle exceeding it, the price touching it. Not too ideal, unlike this clear indication that price moving away, but for simplicity's sake we purchase. Okay, so three shares purchased at this candle in September, and then the next one here, green candle exceeding these two red candles. This is an order block. This candle touches the opening price, moves away very slightly, but for argument's sake, we just purchase at the next candle here. So these are the purchases we bought in 2023. It's about 11 shares, which I will share in a table later on. Now we move on to 2022, right? which is these two vertical points over here. Yeah, it's a bearish year, so ignore this one because this is December 2021's purchase. As you can see, another block was formed here near the low, and price exit. We wait for it to reach back into the opening price, and there was no rejection, so we do not take an entry. Another order block again. We wait for it this reaction to on the opening price, but for here for this example sake, we see that even it touching the wick could be an example of a purchase of a bullish action because it doesn't want to touch the opening price. Instead, it's ready to go further. So we took a purchase here. All right, and then another order block form over here. The touches the candle and moves away, and then we purchase the next candle over here. Okay, and the next example will be here. Oh, okay, sorry, here. They can order block form, but the next candle exceeds the entire order block. So is it valid? The next one here, this low green candle form, and this candle touches the wick over here and moves away. So we purchase the next one. Yeah, and this candle is too thin to be a red candle for the order block, so I don't regard it. I mean, I'm just taking a simple approach for you to identify the order block pattern, and you should try to do this as well. Get acquainted with the pattern and see how price reacts away from the opening price of the red candle, right? So that's it for 2022 and 2023. All right, so this is the year of 2020 where we had COVID, right? So here, this is 2 is an order block, and a green candle exits it by the next candle touches it, and I buy at the next candle. So 2 shares purchased here. Unfortunately, COVID happened. So here, when the order block was formed at the bottom, you can see one red candle and one green candle above it. The next candle touches it and price leaves. So as price leaves, I bought another 2 here, and the next one is over here because an order block was formed here. Price touches this order block's wick and leaves, and I purchased at this candle here in July for 3 shares. And I just want to show you an example that this is an order block as it leaves this red candle here, and you can see price perfectly touching the opening price before it moves away again. And here, look at what you see here, the wick touching the wick, and it leaves. See, order blocks are potting by another order block. So that's part of order block theory. What we purchased here was because this green candle touches this order blocks and leaves, so we purchased another 2 here. And here another block was formed here. Okay, this candle touched the 3 red consecutive order block, so this is part of an order block as well. Touches it and leaves, and I bought it at the next candle over here. And that was about the buying opportunities that we had for the year. Yep, so that's it for 2020. And I just want to move over back to the slides. So I've compiled 5 years worth of data, right, using a weekly purchasing method for lump sum and a dollar cost averaging purchasing plan recurring every start of the month, right? So these are the monthly opening prices, and this I bought 1 share a month. Where lump sum, as I have gone through just now, there was specific price point where the reversal signature occurred, and that's where the shares were purchased. And this tells me how many shares I purchased at each month. So here, the comparison for 2023 was that DCA wins because we just bought 12 shares in total, and this was the value at the end of the year. But we had uninvested cash for lump sum, so our total asset was cash, and 11 shares was about $5,626. So the return on investment was 10.7. This is an added parameter here of just the invested cash, or how much cash you get. So DCA still wins. in this 2023 year. Although you can see here we had a slightly boost in percentage, almost 1%, if you just count by the amount of cash that's invested in shares, right? So this 2022, as usual, we only had this buying opportunity 6 because it was a bearish year, right? So in this bearish year, lump sum wins because you were selective in buying at the bottoms, right? So we can see we had a negative 7.8% loss for the year, whereas for lump sum we had a 3.9% loss. So for 2021, DCA wins again. We can see that yeah, we still in this case lump sum we actually incur more value, so there was uninvested cash for DCA, but DCA still wins a wider margin compared to lump sum, right? And 2020 COVID year, we had an exceptional gain because if you bought the shares in earlier on the price, following the concept of the power of three, you are actually buying near the lows from up to March, whereas for lump sum purchases, when you only purchase the reversal signatures, you're purchasing towards the end of the year where it was a bullish and where orders are already being distributed to higher prices. So, but still formidable gains, I believe, 15.1% for lump sum, but DCA still triumphs with 17.9%, right? And the last year, for our fifth year, we had a 12.1% gain for DCA. But for invested cash, lump sum actually wins here, because I guess because of the low price of shares at that point of time, and it was quite an equal distribution of the shares across the year. So we got more in return, but doesn't really matter, just an interesting data point, I suppose. So this was the summary. The assumption here is that the gains from the years are independent of each other, so the remaining cash is not invested for the next year for just simple calculation's sake. So 2019 to 2023, one green arrow for bullish, two green arrow for very much more bullish, right? And yeah, red arrow for bearish. So we can see DCA consistently performs better than lump sum. So the total value of our investments at 29 December for 5 years purchasing one share each month was $28,000 and 500, right? So total cash that we used was 22.5k cash. All right, so uninvested cash we had $188, whereas lump sum we still had 2,000 over. So the return for 5 years was a 26.5% gain for S&P. As for lump sum we had 23.5%. So what can we take off from here, right? So knowing the theory of the power of three, right? If you are taking a DCA approach, right, and you want to buy at a lower price, so my recommendation here, just a gut feel one, is that buy at 1 or 2% discount off the monthly opening price. It's kind of just a balance between getting your orders filled and getting the best discount. Of course, if you just want to be a no-brainer, just buy at the monthly open, right? Because your order may not be filled because not all bottom wicks are within 2% from the opening price. Yeah. So use a stop loss per your risk appetite here. And for bearish year, you could look for reversal signature and use your lump sum that you have stashed aside. I mean use the lump sum approach for bearish years. Okay, but additionally, you could also set aside additional lump sum on top of your monthly recurring buys. And when you see that a reversal signature has happened, you could buy at that, right? So these are some potential applications that I would think that you can take from what I've been sharing thus far, right? So in conclusion, is there a best time to buy? My answer is not really. because of the efforts to return ratio, right? You used to purchase recurring buys in dollar cost average every month. It's very brainless, right? You just buy every month compared to you having to monitor and setting alerts when price reaches this, observing for the reversal signature, and then you observing price, taking the effort in to go and purchase at that price. It just doesn't really match to the returns that you get, right? And also my data is just for 5 years, and it's based on a weekly time frame. Okay, I didn't go into daily, I didn't go to bi-weekly. You feel free to go and explore this data based on the concept of power of three, because it's applicable for all time frames, right? Yeah. So if you're bullish, buy below the opening price so they get a better discount, and then if it's a green candle, you end up at a higher than the opening price. And just want to introduce you all to the world of backtesting, where you look at charts on the hindsight and detect repeating patterns and use these repeating patterns for your application. So let me know comments on what you think about this video, and if should there be any errors, feel free to let me know. But I hope you enjoyed this one, this light-hearted and playful approach that we have taken to examine, is it really possible to time the market, and is it worth it? All right, I hope you enjoyed this video. Thank you.